What's going on, everyone? I am the host today, Ryan Bakey, filling in for Bill, as well as it looks like going to be filling in for Kenny today. So Kenny has been a late scratch, and Bill was an early on scratch. So it looks like it might just be me for now, but we're hoping to add Kenny a little bit later to it. If you're new, go ahead. If you're new or experienced in the group, go ahead and just comment where you're from. We want to be able to interact with you. So let us know, where you're from, what do you invest in, where do you invest in, and kind of get some conversations flowing. Oh yeah, yes, somebody's from Smith Lake, Alabama. Yeah, Bill has a property on Smith Lake, Alabama. What's the weather like there now? I would imagine it's really cold there. Smith Lake. So I'm just getting a Facebook group pulled up. Let's see. We got Smith Lake, Alabama. We got, let's see the comments. Rainy and cold. Ray from Michigan, STR in Houghton. Is that? Oh, that's on Lake Michigan. Okay, yeah, I'm pretty familiar with the short-term rental markets in Michigan myself. I'm familiar with like St. Joseph, South Haven, those non-STR friendly markets in Michigan, but I still have to explore the other top right side of the mitten because that's where I hear all the actions going on. Yeah, rainy and cold. STR Michigan. Okay, cool. Yeah, so I think most people know, but yeah, so I'm Ryan. I'm from Chicago. I currently have a property here in Chicago, and there's Kenny. He's here. He's back. Let us know. I can't hear you.
Hey.
I think I can.
Sorry.
Now. All right. You were.
Am I good?
Yeah, I can hear you. You got us. Okay. We were just doing introductions, learning from where people are from. We got Smith Lake, Alabama in the house. We got the Lower Michigan, the Mitten in the house. Somebody says they invest in single waterfront homes with 3 to 5 bedrooms. Very descriptive. Single waterfront homes with 3 to 5 bedrooms. Says hi, Kenny. Kenny, you have a fan. You have a fan now.
Lewis Lake, Alabama.
Can you see the comments? Okay, cool. Yeah, so we're just what do we got going on today? What do we want to talk about today?
So we're talking about kind of a continuing conversation that you and I have all the time is what markets that people should be targeting for tax savings and what like kind of characteristics and attributes do those markets have, and so for example, we know that there are some amazing tax savings in the state of Tennessee. And there are a lot of investors looking to invest in the Smoky Mountains area. However, one thing that deters them from actually pulling the trigger is the numbers themselves. They'll look at it and they'll say, well, the numbers don't pencil out, which they really don't. You're talking like maybe a 10 to 13% cash on cash return in those markets. And, that would deter a lot of investors. However, Ryan, you and I have both seen opportunities and deals there that have gone from in the first year, a 13% cash on cash to like a 34% cash on cash because of those tax savings. So I guess my question for you, and like I said, I already know the answer, but we've got all these people on here. Why is that the case? Why is Tennessee special? And how are those deals found there? Or I guess there's opportunity.
Yeah, so Tennessee, Smoky Mountain area has been a very popular tourist destination, short-term rental market for the last few years. Well, really decades, but it's just the market there has absolutely exploded. I've had clients that have bought in 2017, 2018 for $300,000, a couple 3-4 bedroom homes that are now worth $850,000 to $1 million. So absolutely exploded in price. And the thing that why Tennessee, why the Smoky Mountains, for example, is so well off from a tax perspective is that that county, Sevierville County, they have a very low land assessment to the properties, which means the land, when you buy a property, some of the portion of the property is going to be allocated towards the building which can be depreciated, and then some of it's going to be allocated towards the land, which is not. And as an investor, the more that can be allocated towards the building, the better off we are, because that means that the more in taxes that we'll save. And it just so happens that the Smoky Mountains, really out of anywhere in the country, happens to be the most tax-friendly area to invest in. But as we know now, with the way prices are, it's very costly. I mean, you're going to be, for somebody's $50,000-$60,000 of cash flow that they were able to scoop up for $400,000 or $500,000 purchase price 2 years ago, that same cash flow is going to cost you $1 million entry point now. And so I think with the Smoky Mountains, for me, you know exactly what you're getting into. If you're, let's say you're, a high income person and you're trying to get into short-term rentals and you want something that's, hey, safe, it's going to be rented out, I'm not going to have to worry about it not being rented, and I want something that's more of a, let me get my feet wet, like the Smokies is a great area. Are you going to get in there for cheap? Absolutely not. But it is probably a good area to get your feet wet. But then that's where we talk about the difference between cash flow and cash on cash return. Because if cash on cash return is what you're targeting, you're not going to get that in the Smoky Mountains. The deal to pencil out in the Smoky Mountains. Now, we say to not invest into real estate because of the tax benefits, but like to your point, I have a few clients off the top of my head that I could think of where high W-2 income, first short-term rental, they're going to the Smoky Mountains and dropping $1 million in the Smoky Mountains, knowing exactly what they're going to get when it comes to cash flow, but they're more so interested in the tax savings. I just got off the phone with the client today, $600,000 W-2 income, $1 million purchase price in the Smokies. She's saving almost $90,000 this year in taxes because of that property in the Smoky Mountains. So it's, wow. And then because I think it was either John Hodge, part of our mastermind and our accelerator, he asked, I think at one of the meetings, he goes, hey, if I buy $1 million, what can I expect to get back in tax savings? And I told him for high earners, it's typically between 8 to 10% of the purchase price. And this exactly checks out for her, right? So she's investing $1 million in the Smoky Mountains. She's going to get $87,000 in tax savings back. That's really what you can expect for high earners.
So from your perspective, at what point should someone say, hey, I am a high earner and I should be trying to, and I'm looking to invest in short-term rentals or expand my current portfolio, I should employ the strategy? Is there a, I guess my question is, what's the start of being a quote unquote high earner from the tax man's eyes?
I mean, a high earner for me is probably somebody in a 32 or higher percent bracket. So the brackets go 10, 12, 22, 24, and then it goes to 32, 35, 37. The high earner, really high earner right there where it starts to make a lot of sense is once they hit the 32% bracket. But you bring up a good point, and I don't know if we're shifting gears, but it's a good conversation to have, because early on, investors or self-employed people, they want to be able to write off everything in their business or in their real estate. But when it comes to lending and scaling, your lender is only going to add back to your income what they're going to be able to add back per Fannie and Freddie guidelines. And if you're expensing and just taking all these deductions for stuff that they're not going to add back, well, you could be shooting yourself in the foot when it comes to qualifying for more loans. The best example of this is realtors. I see this all the time, where realtors will make $150,000 or $200,000 a year for first or second year, and then they'll go buy a vehicle, and they're able to substantially reduce their taxable income, but the bank is not going to allow them to add that vehicle back to their income. The bank's going to say, hey, you made 120 grand, you spent 50 grand on a vehicle. Well, you really only made 70. So to answer that, it really depends on where you're at in the spectrum of your investing journey. So to me, somebody who is just getting started and is looking to scale their portfolio, they're not really trying to take every single write-off or expense under the sun, because they're going to need that when it comes to qualifying for loans, versus somebody who's already has a well-established portfolio and maybe they pick up a property or two per year, but they're that person that's in that high tax bracket. They're going to want to be able to expense and deduct every single thing that they have possible. So to me, it really is really individual specific and seeing where you're at. So we just had a guy in the Build Short-Term Rental Wealth Facebook group. I believe his name's Cale Delaney. Maybe I butchered his name, but he tweeted, or he dropped in the Facebook group. Just left my W-2 job to do short-term rentals full time. Well, what is he going to be pressed with? Tax returns, right? When he goes to a bank to go apply for a loan, he doesn't have his W-2. So he's going to be in the same boat as you and I, Kenny, when it comes to, hey, you're making this W-2, now you're self-employed. Well, you really just not shot yourself in the foot, but now you can only do DSCR products, right?
Right.
You're not going to be able to get a conventional loan until you have those 2 years of tax returns. So it's all a part of like your strategy, really, per individual.
Can you have, and this is just and everyone listening, I mean, this is why I like being around guys like Ryan or John Hodge, even Jeff Hampton, who's our attorney, and then Bill Faith. We all bring specialties to the table, and I have all kinds of questions about this. Like, so for example, Ryan, so people who are self-employed, can they create a holdings company and then W-2 off that holdings company themselves so they look a little more bankable? Is that an option for this guy like Cale, for example?
Yeah, that's a common strategy that people will use. So there's the investor friendly Ryan answer, and then there's the CPA Ryan answer, right?
CPA Ryan. Let's hear both.
So the investor friendly Ryan would tell you to do that, right? And pay yourself a W-2 wage, so then you can go to the bank and say, hey, look, I have this W-2. But the bank, if they're smart enough, they're going to look through that and see that you own the company anyway, and they're just going to dub you as self-employed.
What if the company was, what if it's a Wyoming company or like a
same thing? I mean, depends on how strict the underwriting is for that bank.
Gotcha.
See, because they'll see my W-2 from my CPA firm, and they'll also see the K-1 hit from my S corporation. They're going to be, oh, he's a W-2 and he's self-employed in his own business. So depending on the lender is if that would slide or not. But
gotcha. Okay, that's interesting. Yeah, we had a fun story. One of the guys in STR Insights, we're a C corporation, and he was doing, I don't know. Well, I know why he was doing it, but he was doing he was paying himself. He wanted us to pay an S corporation, and the S corporation was W-2ing him, and he went to go apply for a bank loan to purchase a house. And they saw that, and they're like, "You're self-employed." And he's like, "Well, no, I work for this company." And then they're like, "Well, you must own that company." And they tried to dig into it, but it's so it was a C corporation out of Delaware, so they couldn't get the ownership, look into the ownership rights or the percentages or whatever, the equity. He didn't own enough for it to even be that way. But anyway, but yeah, I thought that was interesting where they kind of dug in deeper and found that. So that's interesting, though. So.
Yeah,
anyway,
like I said, that's all part of your strategy. So if you listen to any of the podcasts that I have or that I've been on, I always mention that to people when they ask about my experiences. If you're W-2 and you're looking to go full-time self-employed, check your debt to income, but it is really essential that you grab up that last property in that sweet conventional underwriting, rather than being self-employed. And then really the only option that you do have for a year at least is to go that, commercial or DSCR route, because you're not going to get any sort of conventional FHA loan.
Yeah. That makes sense. I think that goes back to understanding how creating your strategy before you start buying a bunch of houses to short-term rental. What are you going to do after, you buy this first one or this third one? What's the plan? What's after that? Where are you trying to go with this?
Yeah.
Just, I had a call with a friend yesterday. He's like, I asked him, I said, he called me and he said, "Hey, Kenny, tell me about where I should invest." And then, so I'm asking all these questions. I was like, "Why are you even getting into short-term rentals?" And he's like, "I want to get rich." And I just started laughing. I was like, rich with, and he's like, money, man. And I'm like, that's not the right answer. I was like, I love you, but that's not the right answer here. Like, we gotta drill down on that because there's so
Yeah.
many you can get caught in some situations. So anyway, let's go back to talking about markets and taxes and things. So I want to talk to you about bonus depreciation and how that changed. Obviously the percentages change in 2023 from 100% things that can be bonus depreciated at 100% to 80%. What does that change in terms of, that's across the country, right? That's not particular markets. So would that change your perception of investing in those maybe more tax-friendlier markets per se, or what's your thoughts on that?
Yeah, you certainly have to downgrade investing in those markets overall. Certainly, they're going to get a little bit of a downgrade just because there's not as much of a tax incentive to invest there. That being said, for high earners, typically 32% marginal brackets and above, it's still going to make a lot of sense to do, even at 80%. And quite frankly, it'll still make a lot of sense even at 60% as well. But it definitely warrants a calculation to see what is actually beneficial now, given that it's at 80. So that same client that I was just talking about, if she was to place, because I was curious about that, and I did the math. If she was to place her property into service in 2022, the 100% bonus depreciation yielded her $87,000 of tax savings. But if she was to place that into 2023, it was only $65,000. So she basically lost 20. She would have lost 20 grand in tax savings, had $20,000 cold cash had she had placed that property into service in 2023 instead of 2022.
Okay, interesting. What can you remind everyone, I guess, listening, what items can be bonus depreciated with short-term rentals?
Yeah, so it's going to be typically anything that's not considered foundational or structural to the property. So your furniture, couch, any sort of desk, fridges, dishwasher, dryer. I'm just like looking into my kitchen right now. Cabinets, some of the millwork, anything that's not structure to the building can be bonus depreciated, and typically that's normally anywhere between 20 to 25% of the building value. So not the purchase price, but the building value, and that's why building value is important, especially when you're talking about the tax benefits, because buying $1 million property in the Smoky Mountains is a lot different than buying $1 million property in Southern California, where the land might be worth 50%. And so then your building value is only $500,000 as opposed to $1 million.
Gotcha. Swimming pools can be bonus depreciated, right?
Yeah.
Outdoor stuff. So we had a conversation about this, which I thought was really interesting. Can you maybe elaborate upon, or I guess let's have it again. When we were talking about adding a swimming pool to a property and kind of how the numbers pencil out there with bonus depreciation and the benefits of that.
Yeah. So if your property is already an existing property and you're going to add on a pool per se, so you might be one of those people in the Smoky Mountains that bought a property that has a hot tub, but you don't have an indoor pool like everybody else does, and now you're trying to compete with those type of people. Or correct me if I'm wrong, but in order to even think about competing in the Arizona markets, you have to have an in-ground pool in the back, right?
Yeah.
Pretty much. Yeah. So you might be thinking about adding that pool in. So what you're going to do is you're going to look at, well, first you need to determine what what's called your marginal tax bracket is. And so that's as simple as just Googling the 2022 or 2023 tax brackets, plugging in your income. Let's say I make 100 grand. Let's see where that falls. Okay, it falls at 22%. That's my marginal tax bracket. And then you take the purchase price of that hot tub or that pool or whatever, and you multiply that percentage by that. And that's essentially what you're saving in taxes by purchasing that asset. So it gets really cool when you actually finance stuff, because it's, hey, I finance, let's say, $50,000 pool. I put $10,000 down on a $50,000 pool, or let's just say, for example, I finance something, but I get a tax deduction 50,000 times 22%. So I'm basically getting $11,000 in tax savings, and I have to come out of pocket 10 grand to buy the pool. Well, you could look at it as like that year I got the pool for free.
Yeah.
But now I
That's
gotta
pretty
make, now I
awesome.
gotta make a payment on it, or I gotta pay it off. That's the only problem. That's the same way that cars, vehicles, that those things work. It's, yeah, you get the write off, but you also have to make that payment somewhere down the line. Well, we do have a question. Facebook user Ali asks, how are condos considered for bonus depreciation? The building value assessment isn't clear for me. So it's probably not clear to you in your scenario because there is no land, most likely. Most condos, you don't actually own any of the land that the condo sits on, and therefore most of your purchase price is going to be allocated towards the building, which is very beneficial to you. And me and Kenny have talked about this before. You know, you buy $1 million property in the Smoky Mountains, you buy $1 million property in Gulf Shores, Alabama, the Gulf Shores land could be 30%. And therefore you only have $700,000 allocated towards the building. But if you bought a Gulf Shores condo, for example, for $1 million, well, now you have $1 million building value potentially. Just check your tax assessment statement to make sure that you don't own any of the land. You could also check the bylaws of the association to see if you own the land. It should be in there too. But your tax assessment statement on the county website, as well as your bylaws, will tell you whether or not you own the land. Hope that was clear. Yeah.
So with condos, townhouses, you actually have to, and for the tax benefits, that's why it's actually pretty nice, is because you most likely, depending on the circumstance, don't own any land.
Yeah, I've seen one client this year had a condo that had land, but that was it. Every other one that I've dealt with didn't have any land.
Yeah, so. And I'm not a big condo person, because the biggest thing for me is it's really hard to differentiate yourself between, your condo and everybody else's condo.
Sure.
But I have seen with John Hodge, I was helping him look and find a condo in Destin and Panama City Beach. And I mean, we found one. It was a good deal. And, it's going to cash flow, and it was decent cash on cash return. And I was very impressed with, and he was only in at $500,000 for a 3-bedroom condo. And so there's definitely opportunity there that, even though not everybody, condos aren't like the sexiest thing to buy or purchase in short-term rentals, they do cash flow, and there could be a decent return on investment, especially with the tax savings. So Don't necessarily shy away from them because myself or Bill Faith say run. So
yeah, and that's typically, like, a lot of people also, condos and townhomes generally don't appreciate. They don't necessarily go up in value as much as regular single family homes. But that does go back to your 4 pillars of investing strategy is what are you exactly looking for out of this investment?
And if it's a
home, you got a lot less maintenance potentially.
Yep. And if it's a lifestyle investment, you're traveling there maybe once or twice a year with your family to vacation. It might make sense. I've seen a lot of people do it. And so it don't, for a pure investment, if it was simply, I want cash on cash returns and I don't, I want to grow my portfolio, and this is an investment only. This isn't a vacation home. For me and my family, then I probably wouldn't go condos, but it really depends on their situation. And, we sit down with a lot of people, Ryan. It's funny, in our accelerator program, talking to the different, students and what they're teaching or what their circumstances. It's all unique. And we have to identify beforehand, before we even get started, where we're trying to go with this and why we're trying to buy short-term rentals. We won't go into that conversation here, but it's so, whether you're thinking about paying, getting the tax savings or future growth, it's so important to identify that beforehand. Um,
Well, I think
so
it all goes back. It all goes back to that, like your strategy too. Because the one guy, Greg from the accelerator, you, he's got a primary home loan, and then he might have a secondary home loan. Well, his DTI is probably going to be maxed out after that. So,
right.
how are you going to scale? If you have a primary home already, and you do 10%, you do 90% LTV on a secondary home loan. How are you going to scale more? Because at one point your debt to income is going to be tapped out. You're either going to have to, get more liquidity within your own portfolio, or you're going to have to go the commercial or DSCR route. So it's interesting.
No, I agree. Cool. So we've kind of talked about a lot of we've mentioned a lot of popular vacation markets, just beaches, the mountains, obviously the Smokies. What other types of markets that you know of from your experience have you seen that have amazing tax benefits that either, let's talk about more popular ones across the country, and then we can even mention the smaller ones that that may have you've like, where is that kind of had to look into?
Yeah, so definitely the markets to look into are going to be, we had mentioned the Smoky Mountains, so that's going to be both North Carolina and Tennessee. Now, if you're Oceanside though, on North Carolina, South Carolina, check the land value. So like Myrtle Beach or Rodanthe, that's how it's pronounced, right? Rodanthe.
Yeah, I
It's
think
like
so.
Outer
I think
Banks.
you got
Yeah.
it.
Yeah. Check that land value, because that one could be very high because of where the land's fixated. But like I said, Smoky Mountains are normally good. Anywhere in the Midwest is typically good. California, not so much, right? So the land there in California and Florida, and basically anything that's touching an ocean, you do really want to check the land value there. And something that we mentioned before too is you want to be doing this anyway before you go to buy the property, because you want to make sure to see how high the property tax bill is going to get reassessed for. So every time a sale happens, the property tax bill gets reassessed by the county. And most of the time, and like, at least in my experience, what I've seen is the longer that the previous owners held the property, the least that thing has been assessed over the years. And so when you come and buy that property from an owner who's been owning it for 20 or 30 years as their primary residence, you're going to get hit with a huge reassessment when you go to buy that property. So just keep that in mind. And the way you do this is you go, Zillow, Redfin, figure out reasonable, recent comps in that area, what's sold, how high has their property tax bill gone up? Because it's all public record. So if I saw that their property tax bill went from 2,000 to 3,000, oh, well, they had a 50% increase. I could probably expect mine to go up by the same too, because it's in the same area, same zip code, reasonable comp, And so you want to do that to figure out your property tax for your pro forma. But now that you also have these numbers, you're also able to figure out whether or not the property is tax beneficial or not.
Yeah.
From a depreciation perspective. Sorry.
Okay, cool. So when it comes to markets like in the Midwest or like Ohio, we, obviously there's like tax savings there for the land to building allocation. Is it really that great of tax savings from those markets, or like, is it just kind of should someone look into those markets if they're trying to get the tax savings?
See, that's the other side of it is those markets are typically good for cash on cash return, but not necessarily overall cash flow. So like I have a property in Ohio that is amazing cash on cash, but my initial investment's only 50 grand. So it's only, a 50% cash on cash return of 50 grand. We're only talking about I'm making 25 or 30 grand a year on it, right? As opposed to if I could get a higher percent cash on cash return somewhere else. It's all part of the things you have to factor in. Your money can only stretch so far in those Midwest markets unless you're like a Starver from our mastermind and you buy a big one in Bourbon. Is it Bourbon?
The Bourbon Trail?
Yeah. Tony's gonna hate me. Bring it up.
Okay.
But
Cool.
yeah.
Or I guess, do you want to take away some of the questions or the one question we got?
Yeah, I think. Yeah. So Shannon, so that most likely it's going to be in. Yeah, there you go. It's going to be if I buy a hot tub after I put my property in service. Is it an asset I depreciate, or can I write it off as an expense? So 90% of the time, you're going to be able to write that off, or I'm sorry, you're going to be depreciating that. So you're going to be bonus depreciating your hot tub. So you still get to take the deduction for it, but you're not able to expense it. So depreciation and expenses are two different things. Depreciating an asset means that your lender will also most likely add that back to your income, versus expensing it or writing it off, as people call it. They're not going to add that back to your income. That's another module for another day, not today though. But
Okay. I was going to ask some questions of that, but anyway. All right, guys. Anybody listening, do you have any questions? Any other questions?
last call for questions here. We'll let everybody out early. I think we had at one point we had 15 join, so I'm sure a lot more
Cool.
people will watch the replay.
Yeah. Cool. Well, I think, what should I do if my LLC is in Michigan and the property is in Tennessee?
LLC is in Michigan property. Yeah, I mean, so I'm not an attorney. That would be a good question for our Jeff Hampton, a part of our accelerator program and super team. But generally speaking, you want to have an LLC in the state where the real property is located. So, property. Let's say I had property in Michigan, Tennessee, and Illinois. I'd ideally have an LLC in each one of those states for that specific property. So you'd probably end up setting up a separate LLC in Tennessee. Cool. Thank you. Yeah, I think that's it. Kenny, where can people find you at if they want to get in touch? STR Insights.
No. I had some work calls, so I just like take off one shirt, put on another. Didn't have time. If you guys want to, I mean, I kind of just asked you questions on here, Ryan, but if you guys want to follow me and kind of my specialty, I don't know if anybody doesn't know who I am who's listening, but I own Short-Term Rental Insights. We're a data platform, help investors find the right markets to invest in. I'm the data guy. So if you love data and other market analytics and other data shenanigans, come follow me, Short-Term Rental Insights, or Bill and I do a podcast together called STR-onomics. I think that's probably the way I'd push you to go, is to go check out our podcast first and listen to those. And we just dropped a really cool podcast on amenities in Gulf Shores and different markets, and which amenities you should have in 2023 and which ones you shouldn't have that don't matter. So anyway, not to put a plug in for our podcast, but I thought I spent a lot of hours on that data, so I want people to listen to that one. So
Awesome.
Anyway.
Yeah, no, I'm just on all social media platforms at Learn Like a CPA. Feel free to message me on Facebook. I typically respond by the end of the day or something. So, all right, guys. Awesome. We'll see everybody next week. Bill should be back regaining the throne, but we'll see you guys next week.